Today we're going to talk about financial freedom, and the scenario is: so you have a bunch of money, and you want to basically live off of that money. So how do you do it? And then particularly, how do you do it in today's low interest rate, just low return in general environment? I'm going to share my screen for the presentation. So if you guys could type in your questions in chat as they come up, but I'm going to actually answer them in the end just to keep the flow going. So I'm going to answer the questions in the order that they come in, and so at the end in the Q&A, I'm going to just go down through the chat and answer the questions. So let's get going. I'm going to share the screen, so just bear with me for 1 second. All right, so here we go. So basically, I'm going to try to skip stuff about myself. Not that interesting, but I've been in the investing business for almost 20 years. Most recently, I started Silver Ring Value Partners 3 years ago after being a portfolio manager at a larger firm. Silver Ring Value Partners is a concentrated value partnership with the goal of having alignment and passion and competence over time. Competitive advantage is really long-term time horizon, limited asset base, a microeconomic focus, and a temperament that allows me to stay rational through the durations of the market. Investment philosophy, it's a long-term intrinsic value approach with a margin of safety coming from both the quality of the businesses that I invest in, as well as the discount to intrinsic value. Have a very long-term time horizon, and stay very rational and disciplined to a rigorous investment process. And the portfolio is a concentrated portfolio of 10 to 20 investments. So anyway, enough about me. Let's get into the topic of today's webinar, which is how do you live off your wealth? So financial freedom to me means that you have enough money so that you can live without needing to generate additional income. And by the way, it doesn't mean that you don't want to do something else. I think many people would enjoy doing other meaningful things, even working. But the key thing is that they don't have to work, right? You basically have the ability to say, hey, you know what? I'm going to do whatever the heck I want because my, living expenses are covered. And the way it works is you have wealth that's large enough so you can withdraw an amount sufficient to cover your expenses, net of any pensions or other guaranteed payments, with a limited risk of running out of money. So we'll talk about that, and we'll go through some very specific scenarios in a minute. So the inputs in this are, basically what's your annual expenses, what are your guaranteed, pensions or other income streams, what's the level of wealth that you're starting with, expected rate of return, how volatile those returns are, and risk. In this case, risk is defined as the probability of running out of money before the end of the desired period. So we're going to work with this example, and I'll show you how I use my wealth simulation tool to model out some of these scenarios. But let's just say you have a situation where you want to have annual expenses of $500,000 a year. Maybe you have an annual pension of $100,000, and so your net annual expenses is $400,000. And let's say your time horizon is 30 years, and that's not atypical. It's as far as someone who's maybe entering retirement and they have a long time span ahead of them, and they and their partner want to basically live off the money they've saved. So let's start with the returns. So one of the things I find that people find really shocking, which it probably shouldn't be, but I still think it is to many people, is that the expected returns today, which is today being like 2019, are far, far lower than they have been historically. And so here, what I have is in that rightmost column, the last 100 years, equities in the U.S. return somewhere between 9 and 10%. And today, starting today, I think for the next 30 years, it's much more likely that we're going to have a much lower rate of return, and maybe 4 or 5%. And that's going to sound a little bit surprising to some of you guys, and perhaps it shouldn't be. But the way to think about it is that you have various components of those returns. You have inflation, which is now much lower than history. You have real GDP growth, which has been running a percentage point or so below historical levels. You have the dividend yield, which is almost half of the historical level. And then you have starting valuation. So if we assume that we're going to end up at an average level of valuation at the end of the 30-year period, you're going to have a negative component to returns from valuation returning to the mean. You might disagree with the specific number on these assumptions, but I think it's hard to disagree with the idea that you basically are likely to see far lower returns than you've seen in the past. So what does that mean? Bonds right now, so if you look at 30-year bonds, they're yielding a little bit over 2% in the US. And stocks, I'm just putting in the assumption that I came up with in the prior table, it looks like a typical 60-40 stock bond portfolio is going to return sub 4%. And that's probably not what people's financial advisors or what the websites you might be reading are telling you. So that's not a very high rate of return. So interestingly enough, I don't think that because returns are lower that they're going to be any less volatile. So historically, U.S. bonds have had a standard deviation per year of about 5%, and U.S. stocks have had standard deviation per year in the high teens. So a 60-40 stock bond portfolio would have had a standard deviation per year of about 12%. Interestingly, value investors frequently say, well, volatility doesn't matter. So basically, is that is that true or is it not true? And I think that volatility doesn't matter if you're going to hold your funds for 10 plus years and you're not going to touch them until the end, because then why do you care about how lumpy the returns are? You only care about the end amount, and that's definitely true. However, I think that if you're taking money out and you're living off of that wealth, then volatility does matter. So I think that it's something to keep in mind, that if you're in the withdrawal part of your life in terms of how you're interacting with your wealth, volatility is going to impact your returns. So let's talk about risk tolerance. I think it depends on two things. One is just your mental comfort. Some people just are much more conservative. Other people, basically just are willing to take much more risk. And then the other factor is, what's your consequence for running out of money? So let's say if you're 40 and let's say you're an entrepreneur, you sold a business and you decided to retire early and do charity work or whatever the case might be. If you run out of money, you probably can easily get another job, right? So it's not, the consequence is not very large. However, let's say you're 70 and you're retired and you need the money to last you until you die, and let's say you have no safety net for whatever reason, you really don't want to run out of money. So the consequences can be pretty severe for some and not so severe for others. So I think that if your consequences are going to be severe, I would aim for a 5% or less chance of running out of money. So there's a couple of ways to phrase the question. One way to phrase it is, so how much wealth do I need given all the other parameters? And a different way might be to phrase the question as, given my wealth, what can I afford to have as my net annual expenses? So one concept that we'll talk about is, what's a safe withdrawal rate? So a safe withdrawal rate, I'm defining it as a percentage of your wealth that you can withdraw without exceeding your maximum probability of running out of money within your time horizon. So basically, you don't want to withdraw so much of your wealth that you're fairly likely to run out of funds before the end of the time period that you need your money to last. So the conventional wisdom is that the safe withdrawal rate is 4%. And I think that that's wrong right now. I think it certainly could have been 4% at some point in time on the higher rate of return scenario, but under the return volatility assumptions presented earlier, it is approximately 2.7%. So so here's what this example looks like in the scenario. So we have the same 500,000 annual expenses, 100,000 pension. So net expenses that we need to generate is 400,000. We need the money to last us 30 years. And expect a return of 3.6% that I reviewed earlier, volatility of 12%, and we want to make sure we don't run out of money more than 5% of the time. So we need almost $15 million in starting wealth in order to fulfill these criteria. Let me show you really quickly, guys, how I get there. So so I'm gonna just switch to Excel for a second, and this is the wealth simulation tool that I use, and what it does is essentially it's a Monte Carlo simulation using these parameters. I just used $10 million here starting wealth, but that doesn't matter. So we have that 3.6% annual rate of return. We have the 12% annual standard deviation, 30 years, and we are running this 10,000 times. So basically, we are probabilistically saying, what does the probability distribution look like under these parameters? And that's what the Monte Carlo simulation is. If you were using this tool live, you would click this button, click run. I pre-ran it for you just because it takes a few minutes to run all 10,000 simulations. But if you go to the output screen, you can see that in this scenario, you ran out of money 5% of the time. The other 95% of the time, your money lasted you at least 30 years. And this is the visual way to interpret that is basically 95% of the time, you still had money left under these parameters at the 30-year mark. And then some other percentages of the time, you ran out of money at various earlier points in time. So you can. That's the way I use this tool, and I use this for myself. If you guys send me an email, I'll be happy to share it with you for free. It's just something I use. It's not some fancy piece of software, but it's helpful to figure this out. So let's go back for a second and go back to the slides. So if you don't like the previous conclusion, what can you do? Well, you basically have two options. One is to lower your annual expenses, and that might not be fun. And two is increase your annual returns, and that might not be easy. So one way to improve returns is to have less of your money in bonds and more of your money in stocks. The question is, how do we do that? And I think one solution that is used, and it's very applicable for this, is to build a bond ladder for the amount of your expenses for the next 5 years. And then you put the rest in equities. I'm going to go through that and how it works. So the way you would build a bond ladder is you would buy 5 zero-coupon bonds with a nominal amount of $400,000, which is your net annual expense, with 1, 2, 3, 4, and 5 year maturities. Basically guarantees that your expenses are covered during almost any foreseeable market crash. And then you invest the rest in equities. So essentially, you're using the bonds to match your future expenses so that you know that no matter what happens, your expenses are covered. So you don't have to worry about that for 5 years. And then, during each normal market year, you replace a rung on the ladder by selling, $400,000 of your equity portfolio and, replacing the far out rung. During really extremely negative market environments, so something like 2002, 2008, 2009, you basically shorten the ladder by not replacing the rung, and then you replace the missing rung during the normal market environments. Your portfolio allocation in this scenario is going to increase in terms of a much higher equity component than the 60-40, and that's going to help you increase your returns. So using this approach in the prior assumptions, we end up with about 85% of our portfolio in stocks. And our safe withdrawal rate increases from 2.7% to 2.9%. And our minimum required wealth drops by about $1 million. So let me just go back to the simulator for a second and show you what that looks like. So basically, as we went from 2.7 to 2.9, it's because our annual rate of return increased from 3.6 to 4.2. Everything else stayed the same. We can now have a 5% probability of running out of money, or less than a 5% probability at that higher withdrawal rate. That's basically the idea here. So I think a major assumption here is that the volatility stays the same, because essentially we only care about volatility when it's down, right? Nobody complains when their portfolio goes up too much. I've never heard anyone complain about that. The complaint is that, hey, the market is at some crazy low price. All my equities are marked to a very low price I don't like, but I'm forced to sell because I need to live off my wealth. So that's why you have the 5-year bond ladder, so that if you're in that situation and it's pretty extreme, you can pass on making a withdrawal for 1, 2, 3 years. Now, I think that one criticism of this approach might be, well, is this market timing? I don't think so. I mean, it's kind of like a cousin, but a distant cousin, in the sense that typically timing the market refers to trying to guess what the market will do in the short term, in the next year or two. So saying, well, the Fed's going to do this, or China's going to do that, or the president's going to do this and that, and this is what I think the market is going to do, or whatnot, or whatever your approach is. This isn't it. I think it's much easier to tell when the market is in an extremely negative state and stocks are at very unreasonably low prices than to guess when this will change. And I think a 5-year length of a bond ladder buys us plenty of time. So I think that since the Great Depression, there probably hasn't been a period of time where you would have run out of money since this five years, and you probably would have been okay even in the Great Depression scenario, because you still have your equities, you basically just not replacing it. So, obviously, this requires some judgment. You have to make a judgment of when a price is really extreme in order to essentially, make this determination. But I think you kind of know. I don't think it's hard to tell when they're kind of like just a little bit less than you would like, but when they're really low, you kind of, I think, can tell. All right, so can we do even better? And I think it's possible to do even better, but it's hard. And I think it requires excess returns above the markets, and that getting that meaningful excess return above the markets over decades is very hard. So why is it hard? Well, first of all, I don't think most people have the time or the ability to directly invest in securities in a way that beats the market. I think majority of financial advisors' main product is really not excess returns. It's high touch service, right? They're kind of relationship people who can craft, competent financial plans, but they're not necessarily gonna, for the most part, generate meaningful excess returns. I also think majority of people who are trying to find investment manager aren't doing so the right way. I think they're focused on short-term trailing returns, and instead they should be focused on assessing process and integrity of the manager. And those are the two most important things. Unfortunately, I think what most people do is they buy, based on how someone has done in the last year or two, and then they sell for the same reason. And as a result, the statistics are pretty incredible. The average investor underperforms the average mutual fund by several percentage points per year. And the way they do it is they buy high and they sell low. It's tragic for the investor. So how impactful are excess returns? So let's suppose you could achieve equity returns that are 3% per year better than the market with equal volatility. And let's stay with all the other assumptions of the bond letter scenario with 85% stocks. Our portfolio return would increase from 4.2% to 6.8%. And what that means is that now we can actually withdraw at 4%. So let me show you that scenario briefly here. So if you look over here, now because of this higher return of 6.8%, because of the excess returns we got in the equity portfolio, we actually can withdraw at the 4% annual rate and have the risk of running out of money be some below 5%. So it actually makes a big difference, because you went from a scenario where you need almost $14 million for that $400,000 of net annual expenses to a scenario where you only need $10 million to achieve that. So I would say in conclusion, we are in a low return environment. So the percentage of your portfolio you can safely withdraw is definitely lower than it has been. That would be the first key takeaway I would leave you with. I think you can increase your returns by using a bond letter, which basically ensures that you will not be a forced seller of equities at extreme, and it allows you to increase your equity allocation and expected returns for the whole portfolio. And then basically, I think that returns in excess of the markets can be very helpful, but they're also very hard to achieve. So before I take your questions, this basically says, don't sue me. I'm just trying my best to be helpful. You can read that in your own time. And if you want me to send you the wealth simulation tool or the owner's manual where I share my investment process, just send me an email at the email address on the screen, and I'll be happy to do so. Also, I have a YouTube channel where I fairly regularly post video content as far as investing and value investing and behavioral finance. So if you want to get regular updates, please subscribe. And with that, let's take questions. So I'm just going to wait for a minute as the questions are coming in, if any. And if not, then we'll end right here. All right, I'm going to wait one more minute. And I think, as I'm waiting to see if any of you guys have any questions, and if you do have questions afterwards, feel free to submit them and I'll answer them in video form on my YouTube channel. I think in general, you want to follow the basics and do no harm. And, I think that wealth is supposed to enable the rest of your life, and you don't want to sit there and fool around with it or speculate in the markets or gamble on some cryptocurrency or something like that. So that's why some of you, this approach might seem fairly basic or without the bells and whistles. But I think for most people, that is the appropriate way to go. I think that there are people where some people might choose to deviate from that, but if they are competent to do so and it's within their circle of competence, so they would know it. And if they're not sure, that means that they're not within their circle of competence. So I see a few questions. So, so the first question is, how do you feel about REITs and MLPs to increase returns? So I think in general, REITs and MLPs, or real estate in general as an asset class, has historically had returns that are in between bonds and stocks. So it's lower than stocks, but higher than bonds, and volatility that's lower than stocks and the higher than bonds. So it's kind of in between. I think just adding REITs in and of themselves, it is not going to help you necessarily. The question then is, do you have some special competence in assessing REITs or assessing real estate? So if you have a family office and you specialize in investing in real estate, maybe you can add value by restructuring a property or doing something like that, then I think definitely that's a way to add value, and that's kind of in that excess return column. But I think that simply adding REITs as a passive investment based on some index or some particular stocks, I'm not sure for the average person that's going to change the equation. The next question was, do you have any resources for finding zero coupon bonds to construct a bond ladder? So I'll follow up. I'll be happy to look them up, and I'll post it when I post the video on the YouTube channel. I am going to put that in the comments. I believe that U.S. government bonds have been stripped into interest only and principal only, so you can certainly find that. Even if you had to use in this low rate environment normal bonds, there would be some reinvestment risk, which is why the reason you're using a zero coupon bond is so you know exactly that in year 3 you're going to have $400,000 mature, and that matches your net expenses. If you were to buy a regular bond, then in year 1 you would receive some coupons, and if the interest rates fell dramatically, then you would not be able to reinvest those coupons at the same rate as the original bond, and your realized amount in year 3 would be a little bit lower. The rates are low right now, that the difference is small, but over time, the difference can be high, and I'll follow up. Next question is, what are your thoughts on local municipal bonds? I don't know a lot about them. I think that, I'm assuming we're not talking about some kind of distressed investment. So I'm assuming the question is not, well, I'm a deep value investor and how do I assess Puerto Rico's bonds or something like that at 50 cents in a dollar, whatever they might have been. I'm assuming we're talking about your very low, low yield tax exempt bonds. I don't think they change the equation. I mean, that's still going to be, it might be slightly better, slightly worse for someone given their tax circumstances. And, if they have some specific views on their municipality or the municipalities that they're studying, but it's not going to change the overall portfolio rate of return drastically. So I don't think it's going to change the answer. All right. So next question is, how do you protect against unexpected inflation? Are tips good enough? What is an ideal strategy? That's a very good question, right? Because right now, inflation expectations are low, but they could be wrong. I mean, remember in the 70s we had inflation in double digits, and short-term bond. You could buy long-term bonds that had a yield to maturity, 13, 14, 15%. So times change. Just because the market expects inflation to stay low does not mean that that is the truth. It's just the market's view at this point in time. So what about tips? So tips, for those of you who don't know, are Treasury inflation protected securities. The problem with tips is they have very low real rates of return right now. I think, I haven't checked, but they might be 0 or negative or thereabouts. Another potential criticism is it's linked to CPI. So the question is are your expenses inflating at the CPI metric or at some other rate? Let's say it has to do more with healthcare, or it has to do more with higher education for your grandkids, or whatever it is you're spending money on. So I think that's one issue. I think the best way to protect against inflation is to own businesses that have pricing power. And this might sound counterintuitive because one way to think about a equity investment is a variable bond, right? You don't know what the coupons will be, but you own all the upside. Versus a bond is usually it's a fixed coupon bond, but you know exactly what you'll get, assuming that bond doesn't default. But there is it doesn't protect you from inflation. So I think the best way to protect against inflation is to own a business that has pricing power. And the reason for that is that you have a situation where if inflation rises meaningfully, then what's going to happen is the business will be able to raise prices and pass that through, and its value will increase in nominal terms. So I think the degree that you're able to own a collection of stocks or a portfolio of businesses that has pricing power, that truly is, I think, the best way, but it might not be an easy way to go for most people. All right, so next question is, in higher than the average volatility, positive return, would you recommend to add another rung or just to keep investing in equity? So this is about essentially, do we expand the bond ladder above the 5 years? I think it's possible. I think, again, the more you play around with it, the closer you start to approach market timing, and the more fine judgment that is required. I think that the problem is, I think, at least for me, and I think even for the average person, you can probably easily tell when this is an extreme negative scenario. How can you tell? Well, every talking head on CNBC is telling you to sell all your stocks. You feel really scared. There's bad news, maybe, God forbid, there's war, there's a recession, there's some scary stuff happening, right? And the markets have plunged quite a bit. That's not a scenario when you ideally want to liquidate any funds, and that's the risk. That's why you don't have all equities, right? If you did have all equities and you had this 2, 3, 4 year downturn in equity prices, you would be forced to sell your equities at a low price, and you would run out of money potentially sooner than you think. So I think that the issue with you certainly could add, if you can detect, like right now, I would say we're probably closest to the other side of the ledger in terms of we're in a pretty optimistic market. Prices are high, but it's, I think, much harder to tell when prices are way too high than when they're way too low. And so I would say that if you're in a market like today, maybe you do start out with 6%, 6-year bond ladder, or 7 or something like that, because that would still leave you with plenty of equities in your portfolio. I think that actually is smart. But again, how do you, you don't want to start trading, playing what people call tactical asset allocation games in most normal years, because it's a game most people will lose. I don't think I could do that well at that game. So that's why I think for the average person, it's safer to just focus on the extreme negative periods, because I think most people can recognize them. So the next question was, any specific types of bonds in the bond ladder? I think government bonds, basically the role of that part of your portfolio is to provide you with guaranteed cash flows that match your expenses. That's the idea, right? Now, you can say AAA bonds. Well, AAA just still means that there's a higher chance of default in the US Treasury. So I would say, and by the way, the spread is tiny. I mean, you're talking about, basis points, or 20, 30, 40 basis points. I don't know exactly the number. So I would say, stick to government bonds, because if AAA is good, why not double? If not double is good, why not single? And pretty soon you might say, well, I can increase the returns of my portfolio by holding junk bonds, which, by the way, yields like 5-6% now, which is a ridiculously low rate for the credit quality of some of those companies. Well, but again, remember, the point of that portion of your portfolio is to provide near guaranteed cash flows so that you don't have to liquidate the higher return portion of your portfolio. So I would say government's easiest, and the amount of extra return you can finagle by increasing credit risk, I would say, is fairly small and not worth it, at least to me. Next question is, what do you believe is the best method of determining intrinsic value of companies? So I think I'm going to defer that question. I have a video on my YouTube channel that answers my approach. And also, if you send me, whoever asked that question, if you send me an email, I'll be happy to send you the owner's manual where I explain it in depth. It's not because your question is bad or unimportant. It is very important, but I just want to stay on topic because I think the majority of people who are listening are focused more on the financial freedom and that aspect of the webinar. So the next question is, for people in their 70s with a few $1 million in assets, what mix of stocks, bonds would you recommend if they draw a fairly small amount for their living expenses? So again, it's tough to give specific recommendations, and I certainly don't want to do that. I'm not a financial advisor. I certainly understand things, but it's not what I do. B is you want to know everyone's specific situations if you were going to give advice. But in general, the less money you have relative to your annual expenses, the more the bond ladder will take as a percentage of your assets, right? So let's say if you only had $5 million, but your expenses were still $400,000 a year, your bond ladder, if you wanted to have 5 years, it would be 5 times 400, $2 million. You would take 40% of your assets, while as at 14 million, it can only be 15% of your assets. So in some ways, you're constrained by your, you're constrained by your assets relative to your expenses. I think that the mix that I had in this example, about 15%, might seem very low to some people who are used to the traditional 60-40 with 40% bonds. But as I demonstrate, I think you get 5 years, assuming that your assets and your expenses are in line. You get 5 years of guaranteed cash flows, and that's pretty long. I would challenge someone to find a period in recent history when that would have worked out poorly. If there is a period, I will stand corrected, but I'm not aware of one. So thoughts include non-U.S. equity assets. Well, I think that it's certainly something you can do. I think historically, international markets have lowered the volatility of the portfolio without increasing return. So that's valuable. I think that the question then is, what about developed markets versus emerging markets, which is what the person asking the question asked. Look, I think that you certainly want to have a well-diversified portfolio, and being diversified globally is certainly fine. By the way, for most people, I think low-cost index funds is certainly a strong default where they should start at that and only deviate if they have a very strong reason to do so. And a credible firm like Vanguard would be very appropriate because I think their incentives are aligned with their investors, and they're not trying to just milk you for extra money. They're trying to do the right thing, which, not to cast aspersions on other firms, but I would say not everyone has the same alignment that Vanguard does, because Vanguard is a mutual firm. So you can certainly have a portion of your portfolio in international stocks. One thing to keep in mind is that a lot of revenues from U.S. companies that are at least listed, say, New York Stock Exchange or NASDAQ, is already international. So I think it's like something like 40% or some number like that of revenues comes from the outside of U.S. listed companies. So you already have some diversification, but certainly I would say having several funds, say maybe a broad U.S. Fund, a developed market fund, emerging market fund, something like that, that's certainly fine and makes sense. Again, I don't think it's going to drastically improve things, but I think on the margin it'll make things better. So next question was thoughts on cash as a hedge in the portfolio given current valuations on bonds and stocks. Well, look, I think cash should be a residual. So for me, it's a residual, right? So I'm an investor in individual securities. I don't invest in markets. I invest in specific companies that I think are mispriced versus their intrinsic value for very specific reasons. And if I can find enough investments based on my position sizing guidelines that I describe in the owner's manual, I would say that there's no reason to hold cash. Now, I also will never stay fully invested just to check the box, which I think a big problem with a lot of mutual funds is they convince themselves that their clients want them to stay fully invested. It's easier that way for them, but I think clients want them to, not lose their money and then make them good returns over time, not just stay blindly fully invested if the investments suck, as a technical term, which you can say right now might be one of those times. So I think cash should be a residual. I think if you're using cash top down, then I think that it's a little bit hard because now you're completely timing the market. So the question is, if you have cash as a hedge, when are you going to deploy that cash, right? And that gets into timing the market. Now you can say, well, I'm going to wait for some market crash, and that can be a reasonable approach. The problem is you might have 5 years before that happens. Nobody knows. And in the meantime, the market might go down 30% in 5 years, but you have been better off being invested. So I really caution people against top-down timing the market. But I do agree that if you don't have good investments, especially if you are a bottom-up investor like myself, you definitely can use cash because it provides you great optionality. Next question is, how long should a value investor wait for the price to catch up to the intrinsic value? I think that it depends. I don't think it's a time frame question. I think that essentially, it's a matter of, is the thesis still in track? Because let's say you buy a company, you think it's worth 100, and you buy it for 50, right? You bought it at half price. Well, if it's 3 years have passed and everything is still in place, the company's fundamentals are still sound, nothing has changed, but the market hasn't recognized that value, why would you sell it just because 3 years have passed? On the other hand, it's very important not to fall victim to behavioral biases and essentially to make sure that you are being honest with yourself of, okay, well, is it really worth 100? Or has, now that 3 years have passed, is there enough evidence that maybe I was wrong and it's only worth 50? So you want to keep an open mind. Remember, the best value investors are going to be right 60% of the time, which means if you own 10 investments, good chances are that 4 of them you're going to be wrong on. So I wouldn't put a time limit. I would be really vigorous in terms of tracking your thesis and making sure that the value you initially estimated is still the case. Next question is, why bonds rather than CDs? I would say as long as something is essentially as risk-free as possible, and some of you guys are in other countries, so I don't know all the nuances of all the instruments available to you, but the point of that bond part of the portfolio is to provide you as close to a sure thing as is possible to meet your cash flow needs for your expenses. So you really don't want to gamble on anything. So if it's government guarantee CDs and they have the same risk of default or lack thereof as a government bond, sure, if they're available in the amounts that you need, go for it. Yeah, and then it's of course the question of where is the higher return. There shouldn't be drastic differences most of the time between the two, because obviously CD rates are related to bond rates and just general interest rates. But if you find some anomaly and they're not taking on more risk, by all means. What you want to avoid is taking on more credit risk for that part of your portfolio. You're going to have already plenty of potential risk in your equity part of the portfolio, and you really don't want to, for a small increment in return, go and jeopardize your ability to weather the storm when the storm comes. Next question is, what's your screening process to find stocks and where you get ideas? I could talk about that for a long time, but I would say, again, I would defer that for 2 reasons. One is I have a video on that I can link to in the comments when I post this on the YouTube channel. So for those interested, you can check it out. And also, if you want to send me an email, I'll send you my owner's manual where I describe that. But again, I rather than talking about myself, I was let's say I want to stay on topic for the webinar, since that's what most people have joined us for. But good question, certainly a fair one. Happy to follow up offline. All right, I'm gonna give another minute or so. Those were good questions, guys. Let's see if any more come in, and if not, then we're gonna wrap up. All right, so I don't see any more questions. So I want to thank everyone. So let's see here. I want to thank you guys for the for your time. I want to thank you for your questions and participating. If you like this video, please sign up for the YouTube channel where I post regularly as far as investing related content. And thank you. And until next time, take care.